The cryptocurrency market often appears chaotic, with prices surging or plummeting in ways that defy simple explanation. Yet beneath this surface turbulence lies a structured interplay of forces that drives its movements. Many observers mistake these fluctuations for pure randomness, influenced solely by breaking news or viral social media trends. In reality, they overlook the deeper psychological and economic patterns that shape the market's behavior over time. This misunderstanding leads countless participants to chase illusions, reacting impulsively rather than anticipating the underlying rhythms. Consider how human emotions amplify market dynamics. Fear and greed form the emotional core of crypto's volatility. When prices rise steadily, optimism spreads like a contagion, drawing in more buyers who fear missing out on potential gains. This creates upward momentum, but it often builds on fragile foundations. Conversely, a sudden drop triggers panic selling, as participants rush to minimize losses, accelerating the decline. These cycles are not accidental. They reflect collective psychology at work. Market structure plays a pivotal role as well. Liquidity, or the ease with which assets can be bought or sold without drastically affecting prices, varies widely in crypto. In thinner markets, even modest trades can spark exaggerated movements. Large holders, often called whales, exploit this by strategically placing orders that influence smaller participants. Their actions create waves that ripple through the ecosystem, sometimes intentionally manipulating sentiment. Economic factors weave into this fabric too. Broader macroeconomic trends, such as interest rate changes or global uncertainty, exert subtle but powerful pulls on crypto valuations. When traditional markets falter, investors may flock to digital assets as perceived safe havens, inflating prices temporarily. Yet this influx can reverse just as quickly when confidence in the wider economy rebounds. Technological developments add another layer. Innovations in blockchain scalability or regulatory clarity can shift perceptions of long-term value, prompting sustained trends rather than fleeting spikes. However, hype around unproven advancements often leads to overvaluation, setting the stage for corrections. Understanding these elements requires stepping back from daily noise. The market moves in discernible phases. Accumulation, where informed players quietly build positions. Markup, characterized by rising enthusiasm. Distribution, as early entrants sell to latecomers. And markdown, the inevitable downturn. Each phase builds on the last, driven by shifting balances of supply and demand. For instance, during accumulation, prices stabilize at lows, luring patient observers while deterring the impatient. As markup begins, positive narratives dominate, fueling broader participation. But in distribution, subtle signs emerge, perhaps unusually high trading volumes without corresponding price gains, indicating that savvy actors are exiting. Markdown follows, often brutally, as reality tempers earlier exuberance. Psychology intertwines with these phases, creating self-fulfilling prophecies. The herd mentality pushes prices beyond rational levels, only for contrarian forces to pull them back. External shocks, like regulatory announcements, act as catalysts, but they merely accelerate existing trends rather than inventing them. A common mistake is attributing all movements to isolated events, ignoring the cumulative buildup. Traders frequently over-leverage, borrowing to amplify positions, which magnifies gains but devastates during reversals. This leads to forced liquidations, cascading into broader sell-offs. Another pitfall involves confirmation bias, where participants seek only information that supports their views, blinding them to warning signals. To navigate effectively, watch for divergences in sentiment and price action. If enthusiasm peaks while volumes taper, a reversal may loom. Pay attention to on-chain metrics, such as unusual wallet activity, which can hint at impending shifts without relying on speculation. Avoid the trap of emotional trading. Set predefined rules to counteract impulses. Recognize that volatility is inherent, not a flaw. It's the price of potential innovation in this space. Contrarian thinking serves well here. When consensus screams buy, consider the risks. When despair reigns, opportunities may hide. Yet, remember, no pattern guarantees outcomes. Markets evolve, incorporating new variables. In essence, the crypto market moves as it does because it mirrors human nature amplified by technology and economics. By grasping these forces, one gains not predictive certainty, but a framework for wiser engagement. This knowledge demystifies the apparent chaos, empowering participants to act with clarity rather than confusion. Crypto doesn't have to be confusing. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.